Hey Barry, how's it going?
Pretty good. How you doing, Mike?
I'm okay. All right, so this morning we had this awful news that the unemployment claims was 3.2 million, something like that, by far the highest we've ever seen. I think by an order of magnitude of like 5 times higher than we've ever seen. And on the release of that, the futures market, this was at 8:30, the futures market spiked higher a little bit. And then it has continued to climb higher all day. And now the market is up. The Dow is up 5%. The S&P is up almost that much. What is going on?
So people seem to forget. They think the news release is actually news, when in fact, this is old data. I ran a chart of this from EPI.
Wait, what do you mean it's old data? Explain.
So everything is assembled by the various states. They share this information with BLS and Commerce Department, but it's not impossible to figure out in advance. And when the news is released, well, it's officially released, but we've seen this data before. Estimates of 3 million plus were out there on Wednesday's reads. I had the chart from EPI that came out Tuesday that showed 3.3 million new unemployment claims. They estimated that from all the various state data. So this wasn't a big shock. I think if anything, the markets might have been a touch relieved that it wasn't worse than this. Oh, it was only 3 million and change. It could have been 4 million. So go ahead.
I think that there's some truth in there, but I do think that this was a reaction to the news, and it was less bad than expected. Obviously, it was catastrophic, but maybe not quite as catastrophic as the market had expected, even though the numbers were out there, because this was literally at 8:30, the market spiked. So I'm not saying that the entirety of the move is because of this, because it's hard to separate the cream from the milk or from the chaff.
Right,
in other words,
right.
what percentage of this gain is because of the fiscal stimulus package that's ostensibly going to be passed tomorrow?
Right. So it's kind of weird. The fact that it hasn't been passed yet by the House and signed by the president sort of keeps it hanging there. Look, think about how the markets have reacted to the entire coronavirus situation. 5-6 weeks ago, the market started selling off hard in anticipation of a drop in revenue and corporate profits. Hey, you're not going to get Dow 30,000 or where was the S&P? You're not going to have 3,000 on the S&P if profits and revenues plummet. So the market saw through the fall off, but it didn't see as far as the stimulus package. No one knew if there would actually be a stimulus package. There always is some. You don't know how big it's going to be. Last time it was pretty much all monetary, no fiscal. This time it's both. So when you have, as you wrote on your blog, the fastest bear market in history, the market rubber band gets stretched so far that on any good news, it comes snapping back. I'm not a big believer that, hey, it was only 3.3 million new unemployment claims. We know that unemployment's going to be 20, 25, 30%, like going to make the Great Depression look like a party, but we also know it's temporary. And as we fell far enough and got extreme enough, markets, instead of looking forward to the recession, markets are now looking forward to the other side of the recession. Or, that's a neat little narrative, it could just be that we got so deeply oversold that we're snapping back and making up half of the losses right about today.
Renaissance Macro tweeted that Governor Newsom said that California alone is going to have 1 million claims, and this one, it showed 186,000. So it could even be worse. It's probably going to be worse. But so it's hard to know. Typically, markets, when markets go higher on bad news, that's pretty bullish. But stocks were so extended to the downside, a complete washout based on every single measure of breadth that you look at. We were due for a snapback. So is this sustainable, or is this a dead cat bounce, a bear market rally that's going to roll over? Obviously, nobody knows.
So, well, the best answer to that is tell me how far the infections of the coronavirus run. Tell me how many people actually get this. Tell me how many deaths there are. And then we could try and figure out how long this lockdown is going to be for. Look, 30, 40 million people unemployed, 50 million people, that's possible. If it's a month, if it's 2 months and we come snapping back, come out the other side and, hey, maybe there's a cure, maybe there's a treatment, maybe there's a vaccine. Any of those things happen in the next 30, 60, 90 days, look out. We're going to come screaming back. If, on the other hand, this is a long, slow process and the recovery isn't a V in the economy, but if it's more like an L that goes on, remember, after the financial crisis, it took us a solid 10 years to make up all the jobs that were lost. I don't think this one will take that long, but I think it's a little wishful thinking. It's a little optimistic to say, hey, after we're done, it's going to be snapping back and everything will be hunky-dory. Markets are fast. The economy tends to move slowly.
Let me ask you this. Do you think it's wishful thinking? I mean, I think that it's wishful thinking that earnings are going to rebound and be where they were just 3 months ago in, say, 6 months, 12 months. I don't think that's going to happen. But even if it did, don't you think that it is absolutely wishful thinking to think that investors are going to pay the same multiple as they did 3 months ago?
So you know my theory that bull and bear markets are best defined by the tendency of investors to pay more and more for the same dollar of earnings. That's a bull market. And bear markets is the tendency to pay less and less over time for the same dollar of earnings. So really you're asking a broad sentiment question.
But with the obvious statement that in bear markets earnings are declining, in bull markets they're rising. So it's like fuel on the fire in both ways.
Right. Go look at 82 to 2000. 75% of the market gains from 1982 to 2000 were not due to rising earnings. They were due to multiple expansion. And so we've been seeing a pretty robust multiple expansion over the past decade, but we've also seen a recovery in earnings. And remember, when you have rates as cheap as they've been, when you've had the cost of capital and borrowing so low, that adds to the corporate profits, as well as the giant buybacks we've seen has also improved the PE ratio. So
a reduction in share count.
Right. So I'm not sure what the final, nobody knows what the final bailout package is going to look like. Will there be a penalty for, let's say, airlines that have spent 93% of their free cash flow buying back stock instead of saving money for a rainy day? One of the things that the coronavirus has revealed is a deep flaw in capitalism and just-in-time supply chains. How is it possible that community hospitals don't have emergency gloves, masks, and disinfectants? How is it possible that the entire supply chain of things like food and ventilator and paper towels and toilet paper, supermarkets don't stock any of this stuff in reserve? The entire structure, to quote Nassim Taleb, is way too fragile, and it should be built with far more resiliency. If anything, that there's a takeaway from COVID-19, we need a system that's much more resilient than what we have. And that means you can't have a supply chain of a day's worth of stuff that if there's any sort of lockdown, we're screwed. And that's been a big reveal of the pandemic. We are not well structured for emergencies.
All right. I think that's a good place to leave it. Thanks, Barry.
As always, thanks, Mike. I love, big fan of the podcast.
Yeah, I love you too.
Love your work.
I love you too.
First time caller, long time listener.